Hey traders, Jason here from Levitt Brothers. So the market's in pretty bad shape. Okay, we all know that. But it's starting to become a concern that the market can't bounce. Okay, even in a weak market, in a bear market, in a market that is heading lower and is going to continue to head lower, there still is some back and forth movement. Couple steps down, a little pop, couple steps down, a little pop, couple steps down, maybe some sideways movement for a few weeks. The price action is orderly, and even though the market's weak and going lower, there still seems to be, it's operating in what you consider to be like a normal fashion. Unfortunately, what's taking place right now, I would not consider to be normal. It can't bounce. Okay, it can barely move up for even a day, and even intraday, it can't even move up for more than a couple hours. And this is taking place at a time where some breadth indicators are printing their lowest levels since the financial crisis. Okay, so by many measures, this is the worst the market has been in 13, 14 years. And if it can't bounce under this condition, then to me, like, there's a legit chance that we can enter crash mode soon. If we can't bounce when some breadth indicators are pressed at the bottom of their 14-year ranges or at 14-year lows, then I'm starting to wonder if there's a door underneath us that if we go through that door, the market just collapses. Okay? It's not a prediction. It's just a bad feeling I have because the market just doesn't seem to have a whole lot of life. And so in my mind, I'm thinking this market needs to bounce or else it's truly in trouble. Okay? At Levitt Brothers, I've been fully transparent. I've said like market's going to like at least the low 3,000s, S&P 500 low 3,000s. Right now it's at like 3,600. So we're talking another 500-600 points to go. I've been out there saying that over and over and over, but that doesn't mean we have to hit some sort of trapdoor and just collapse there all at once. Okay, the market can move in an orderly fashion. It could take many months to do that. It doesn't have to just crash. And the fact that it can't bounce right now is a concern. So let me show you some of the charts I'm looking at that have led me to start thinking that. All right, so here's the S&P 500 with the NYSE AD line, the 10-day moving average of the AD line, and the 20-day moving average of the AD line. Okay, so this print right here and this print right here from the 10 and 20 are the lowest prints since the financial crisis. Okay, so 10-day, 20-day. So over the last 2 weeks and 4 weeks, the market has not been in this bad a shape since the financial crisis. Every other pullback we've had, whether it was 2011, 15, 16, 18, you name it, the last 2 weeks and 4 weeks have been worse than any other period per the advanced decline line since the financial crisis. Okay, if there was a little glimmer of hope, it's just that the fact that the S&P made a lower low last week, and it looks like we might have positive divergences forming, which is great. But my point is that when these indicators push to this type of an extreme level, it should be able to bounce fairly easily. And if it can't bounce under this condition, we're in trouble. Next chart, this is the S&P 500 versus the breadth thrust. The breadth thrust is the NYSE advancing volume versus the total volume. It's actually the 10-day moving average of the advancing volume versus the total volume. Divergences work great with this. Extreme prints also work great. This is the lowest print since the COVID low in March of 2020, and the second lowest print since 2011. So only two prints in the last 13, 14 years have been worse than the print that we just got last week. Okay, so again, if the market can't bounce from this type of an oversold situation, something is seriously wrong. It means the market is not operating normally. Okay, and like the last indicators I showed you, it looks like we might have a positive divergence forming. So it looks like a bottom is trying to form, and it should form, and we should get a decent bounce out of this. And if we can't, look out below. So here's the S&P 500 versus, in green we have new highs. In red we have new lows, and then down at the bottom we have the high low. Okay, so a couple things is like when you get a spike in new lows, you get bottoms. Okay, there was a tradable bottom. Okay, then we got a divergence here where stock market went to a lower low, but less stocks were making a lower low or a new low. So then we got a bounce there. We got a spike over here, pinpoint the low here, and now we got a spike here. So we should be able to bounce here. Okay, when you get a spike in new lows, they pinpoint pretty much new lows. Even like these moderate spikes here, like boom, 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 they correspond to this, this, and this. Okay, so we should be able to get a tradable bounce with the spike in new lows. It hasn't happened yet. This, of course, shows out in the high low. So it's something to watch for. Okay, if the market is healthy, and healthy, it doesn't mean it's moving up. It just means it's operating and functioning with everything operating smoothly. It could still be trending down in a normal, healthy way. So I'd argue that if the market can't bounce under this circumstance, then it's really in trouble, and we're in danger of the trapdoor being pulled out and it entering crash mode. There is a little bit of a hope here because we're starting to get, we got lower lows last week, and then we got less new lows at the end of the week. So that's a little bit of a help, a little bit of a hint, a little bit of a point of optimism that the market dropped to a lower low, but less stocks were printing new lows. So again, we should be able to bounce from this situation, and if we don't, we're in trouble. Okay, last chart. Let me draw a line here. This is the 5-day total of new highs of the high low. Okay, so we have a spike down here, as you'd expect, and look at other spikes. We have a spike down here, that low, a little spike down here, that low, and prior to that you have the COVID low there, boom, and you have the end of 2018 low there. Okay, so spike downs tell you that stockholders are throwing in the towel, they're giving up, they're panicking, they're selling at all cost, and this indicator spikes down. So if we can't bounce from this condition, we're in trouble. Okay, it should be fairly easy for the market to bounce. With the current volatility, it should be fairly easy to bounce a couple hundred points in the next couple weeks with the indicators pressed to these levels. On Thursday and Friday, this indicator moved up, so it looks like we have the start of a positive divergence, which is good. So it just adds to it. Not only are we getting a spike down, but we're also getting a divergence. Okay, so there are other indicators. These are just the ones I follow closely. The market's not healthy. It's going to go lower, but even a market that's going lower should operate in a normal capacity. And when it doesn't have the ability to bounce, when it so obviously should, when there's so many things stacked in its favor, it possibly could cross the threshold and completely collapse. And that's what I'm afraid of right now, and that's what we have to look out for. All right, I'll see you next time.